Types of balance sheets. Classified balance sheet. The classified balance sheet is the most commonly used type because it provides a clear and organized view of a company's financial position by grouping similar items together. It categorizes assets into current and non-current, where current assets are those expected to be converted into cash or used up within 1 year, such as cash, accounts receivable, and inventory. Non-current assets, also known as long-term assets, include items that will provide economic benefits over a longer period, like property, plant and equipment, intangible assets, and long-term investments. Liabilities are similarly categorized into current and non-current. Current liabilities are obligations that the company must settle within a year, such as accounts payable, short-term loans, and taxes owed. Non-current liabilities, on the other hand, are long-term obligations that the company will not pay off within the next year. Examples include long-term debt, bonds payable, and lease obligations. Equity is also broken down into categories such as common stock, preferred stock, retained earnings, and additional paid-in capital. This structure allows stakeholders to quickly assess the company's liquidity, its ability to meet short-term obligations, and solvency, its ability to meet long-term obligations. It is particularly useful for investors and creditors who need to understand the financial stability and operational efficiency of the company. Unclassified balance sheet. The unclassified balance sheet presents all assets, liabilities, and equity items without grouping them into categories like current and non-current. Instead, it lists all assets together, all liabilities together, and all equity items together in a simple and straightforward format. This type of balance sheet might be used by smaller businesses or companies that are not required to provide detailed financial information. While this format is easier to prepare and understand, it does not offer the same level of insight into the company's financial health as a classified balance sheet. For instance, without the distinction between current and non-current items, it can be more challenging to assess the company's liquidity and long-term financial obligations. Comparative balance sheet. A comparative balance sheet displays financial data for multiple periods side by side, allowing for a comparison of the company's financial position over time. This type of balance sheet is particularly useful for identifying trends, such as increasing debt levels, growing assets, or changes in equity. It helps management, investors, and creditors understand how the company's financial situation has evolved and can inform strategic decisions and future planning. The comparative balance sheet typically presents figures for 2 or more consecutive years, making it easier to see changes in assets, liabilities, and equity. For example, an increase in current assets over several years might indicate improved liquidity, while an increase in long-term liabilities could signal rising debt levels. Common size balance sheet. The common size balance sheet is another analytical tool that expresses each item on the balance sheet as a percentage of total assets. This format allows for easy comparison between companies of different sizes or between different periods for the same company. By standardizing the financial information, it helps identify trends and analyze the relative proportion of each item on the balance sheet. For instance, if a company has a high percentage of its total assets in receivables compared to its peers, it may indicate a potential issue with collecting payments from customers. Similarly, a higher percentage of liabilities might suggest a greater reliance on debt financing. This type of balance sheet is particularly useful in benchmarking and financial analysis, providing insights into the structure of a company's finances and allowing for easier comparison across the industry or over time. Consolidated balance sheet. The consolidated balance sheet combines the assets, liabilities, and equity of a parent company and its subsidiaries into one document. This type of balance sheet is used by companies with multiple legal entities under their control and provides a complete picture of the financial position of the entire group. In a consolidated balance sheet, intercompany transactions and balances are eliminated to avoid double counting. This means that any transactions between the parent company and its subsidiaries, such as loans or sales, are removed from the consolidated figures. The consolidated balance sheet is essential for understanding the overall financial health of a corporate group, as it reflects the combined financial position of all the entities under the parent company's control. It is particularly important for investors, creditors, and regulators who need to assess the financial performance and stability of the entire group, rather than just the parent company or individual subsidiaries.